It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. I think today we're going to take a little bit of break from politics. And I think the reason is it's gotten really dark recently. And if you don't know what I'm talking about, just listen to a couple of Biden's recent speeches. The most recent one, for example, that he shared on Labor Day, where he's attacking MAGA Republicans for being threats to the democracy and many other negative things. And I don't know about you, but I find it an incredible turnoff. I think a politician should be more about what is their plan, what are they going to do for us. I mean, for gosh sake, they're our representatives. Okay, they're supposed to be, at least. I much rather hear more about what are they going to do for me rather than attacking the other guy. And I hope they do it because obviously it works. Otherwise, they wouldn't do it, right? I just hope and pray that this time it just backfires on them massively, because they've been, Biden in particular, Democrats have been really, really attacking recently. And I hope people get fed up and tired of it and say enough's enough and just vote the bums out, right? Get rid of those people that, if 75% of Americans think the country's headed in the wrong direction, and there many, many polls have been stating that, for gosh sake, wake up for a minute, pay attention and listen. You know what I mean? Dude, your administration's going the wrong direction. The people are telling you and you're just not listening. And if somebody doesn't agree with you, that doesn't make them a threat to a democracy or an enemy. It means they don't agree with your ideas. Your ideas are wrong. You are wrong. How hard is that to figure out? But they don't do that. They decide to attack the other side because they don't agree, or the majority don't agree with their ideas. Anyway, that's my little rant on that for a few couple of minutes. What I really want to focus on more is a lot of the economic things that are going on, because there is a lot of stuff going on economically that's really valuable and very important, I think, for people to understand. And like I've been saying for a while now, how do we navigate this economic chaos we're in? I mean, we're in 40-year highs of inflation. We have rapidly increasing interest rates. And I think that's one of the biggest things we need to understand and deal with right now. See, for the last decade plus, one of the comments that you always would hear from people that invested in Wall Street and things like that, they would always say, don't fight the Fed. And it made a lot of sense because the Fed was, giving us easy monetary policy, really low interest rates, cheap money, easy access to lots of funds, so businesses could expand, grow easily. Real estate values were going up through the roof in a lot of times, a lot of places, and it's because of extraordinarily low interest rates, easy monetary policy. And when the Wall Street would say, or investors would say, don't fight the Fed, they were right, because the Federal Reserve is really like the 800-pound gorilla in the room, if you know what I mean. And they are going to not control, but certainly impact or influence significantly our economic situation, investments, and all those kinds of things. So to ignore the Fed is to do so at your own peril. So it's really important to understand where the Federal Reserve is at, where they're going, and what they plan to do. And unless you've been under a rock, you know that they have been raising interest rates rapidly. Several times this year already. And it appears they're going to continue to do so and hold those rates for quite some time. And that's why we've seen it's no secret, the stock market has been really rough in 2022. The first 6 months, for example, of 2022 were the worst first 6 months of any stock market since 1950. That's a fact. That's a statistical fact. So you're talking about the worst first half of the year. for the stock market in over 70 years. Okay. Well, folks, it looks like it's going to get uglier before it gets better. And I'm going to share with you some reasons why. And there's an article that I read that I think really, I always like to cut through the noise, if you know what I'm saying. It does a really good job, and something I haven't seen anywhere else. It's through Investors Business Daily. We're going to post this on our website at yourpersonalbank.com, this particular article, because I think it really addresses some issues and helps folks understand maybe a little bit more, again, where the Fed is at, what they're thinking, where they're likely to head, and why. And I'm going to tie your personal bank into all this, because if you haven't considered it seriously, or maybe you did at some point previously, folks, it's getting more and more viable. I mean, it's always been a good thing, but it's getting more and more viable as a investment alternative, or frankly, for some people, becoming their primary financial tool. And it's going to grow and be stronger as we go forward, particularly with higher interest rate environment that it looks like we're going to be dealing with for at least the next several years. Yes, you heard me say that. You know, we were told by our Federal Reserve Chair and our Janet Yellen, the Treasury Secretary, and others, that inflation was transitory. They were trying to tell us that last year. I emphatically disagreed strongly with that. So did many other economists and financial experts. It wasn't rocket science, folks. Okay, but let me go back for a minute. Let me take a couple of minutes here. For those of you that maybe are new to the program or haven't fully understood how the personal bank concept works, why this is so important, and then I'm going to tie it in with, again, what the Fed is doing and how it's going to affect just about every asset class out there. Okay, so your personal bank is really, it's very simple. It's a two-step process. It's not complicated, folks. What we do is we set up a high cash value policy. And we have companies that are paying dividends right now at 5.75 to 6% dividends currently. And that is after a 12-year period of having the lowest interest rate environment in the history of our country. That's a literal statistical fact. Okay? So, from a financial return standpoint, these companies, the dividends that they pay are highly aligned with interest rates. They're highly influenced by interest rate because insurance companies invest a lot in bonds and things like that, which are very interest rate sensitive. So literally, these companies have come through the worst decade or so in terms of returns, financial returns, in their history. And these companies that I deal with, all of them been around for over 100 years, some of them as low as 170 years. Okay? The fact that they're still paying 5.75 to 6%, even after an incredibly low interest rate environment, is remarkable. I mean, to put things in perspective, what kind of interest were you getting at the bank on a CD or bank investments or savings or checking? I mean, next to nothing in many cases, right? So you were talking about interest rate sensitive assets, things that were guaranteed, had tax benefits, all that. They, for the past decade, have had extremely low rates of return. Yet, these companies are still able to pay dividends, like I said, in that upper 5-6% range. That is truly impressive. Now, every company I've talked to, they're all saying the same thing. Dividends are going up. Why? It's quite simple. With rising interest rates, again, dividends are highly interest rate sensitive. The Federal Reserve has nearly doubled rates already in just the past few months. Let me give you a couple examples to help you understand. If you were looking at a 30-year fixed mortgage early in 2022, you could get one in the 3%, even high 2% range. Today, that same mortgage, that's for somebody with really good credit, that same 30-year fixed mortgage is 6.5 now. Folks, that's double. Why? Well, as recent as March of 2022, the prime rate was 3.25. Now, if you don't know what prime rate is, it's the Wall Street Journal prime rate. It's adjusts monthly, and it's basically considered the rate that is the best rate an individual borrower can borrow money at. And the prime rate was 3.25 in March of 2022, like I stated. And you could get a 30-year fixed mortgage right around 3%. So they're highly tied together. You see what I'm saying? Now, today, as we speak, this is now September, okay, of 2022. The prime is 5.5% and is likely to go higher soon. Again, I told you 30-year fixed mortgages right now are 6.5 with good credit. Why? Again, it's based on the prime, one, and where the banks anticipate rates are going. In other words, the 30-year fixed mortgage is slightly higher right now than prime because, well, pretty much everyone knows the Federal Reserve is going to raise rates in the future. Why? Because the Fed has told us they're going to, okay? It's not complicated, all right? So with dividends, or I should say with interest rates increasing strongly, and quickly, rapidly. This is fast, folks. This is way, way faster than what typically happens. I mean, the Federal Reserve normally raises rates or lowers rates 1/4 of a point at a time. We've had three-quarter rate interest rate moves increases this year already. We'll probably have more, okay? So this is aggressive, this is fast, this is rapid. Now, I'm going to encourage you to stay tuned in the next segment because I'm going to talk more about and share more of this article about why the Federal Reserve is raising rates so rapidly, so aggressively, and talking about doing more. And not only that, keeping them there for a while, okay? So I'm going to really encourage you to stay tuned on this. Of course, you can always contact me at yourpersonalbank.com for more information. But what I want you to understand is Your Personal Bank dividends are at the lowest they've been, well, in decades and decades, and are on the rise. So this is something that's, buy low, sell high, right? This has been on the low end and is increasing. We are likely going to see increasing dividends for the next several years. Okay? So that's the situation we're looking at. I'm going to share more about that and what kind of dividends we should be expecting to see soon in the next segment. So stay tuned. Don't miss it. And like I said, contact me for more information at yourpersonalbank.com.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And like I said, if you're looking for a political discussion today, as I stated in the first segment, taking a little break from it because things have gotten really dark. And like I said, if you don't know what I'm talking about, just go and listen to the most recent Biden speeches, and you'll know what I'm talking about. He's basically, he's attacking, in my opinion, half of America for not agreeing with him, calling them threats to democracy and other stuff. And I just find it really ugly. I find it a turnoff. I hope most people do too. And for anyone that supports or encourages this kind of behavior, or these kinds of actions, instead of sharing with us what you plan to do, you want to attack the other guy or gal, you should just be voted out, in my opinion. You're supposed to be representing us. Let us know what you're going to do. And if your plan's better, then share why. And if we like it, we'll support it. And if not, we'll support the other person. That's called democracy. And, if 75% of Americans think the country's heading the wrong direction, wake up and smell the coffee, dude. You know what I'm saying? But anyway, I want to go back to, like I said, the economic stuff and the Federal Reserve. So much stuff is going on there. We really need to address this, and also how this affects your personal bank and how it affects your finances, investments, assets, everything. And like I said in the first segment, that a very common statement was, when investing in the markets and stuff, is don't fight the Fed. And they're right. The Fed's for the past decade plus, was generating very, very easy monetary policy, low interest rate environment, easy money, build, grow your business, cause real estate values to skyrocket, all of those things. Because again, low interest rate, easy monetary policy, folks. Those days are over, and they're over fast. And the Fed is aggressively increasing interest rates. They basically, well, let's put it this way: they have doubled the rates in the last few months, and it looks to be that they're going to continue strongly increasing. And here's the most important part: why the stock market recently took another drop down is they're planning to keep them there a while. Okay, and there's several reasons why. I'm going to get into those, I promise. But before I do, as I was sharing in the last segment, your personal bank, the dividends that you earn are highly interest rate sensitive. That's why it's so important to understand where things are going. And dividends with these, we set up a high cash value policy, of course, to earn dividends. Grow our money. It's really quite simple, okay? And the company's been paying 5, 7, 5, 6% still today, even with the extremely low interest rate environment that we've been dealing with for the past decade plus. All the companies have come out and have said, we're raising rates, okay? To give you an idea, we don't know because they announce them annually. Well, let me give you a couple of ideas. First of all, the CFOs of one of the companies I was talking to not long ago mentioned that at the beginning of 2022, the bonds that they were purchasing, which was the bulk of their portfolio, which is the bulk of any insurance company's portfolio, they were getting 2% on their bonds. As soon as the Fed now, by the way, these companies make money on other ways too. They're venture capitalists. They do that kind of stuff also. But a bulk of their portfolio is bonds, and that's why it's so highly interest rate sensitive. They were getting 2%, like I said, at the beginning of the year 2022. As soon as the Fed announced they were going to raise rates, they hadn't raised them yet. As soon as they announced it, the CFO stated we started getting 4%. In other words, doubling the returns on their portfolios just on the announcement that the Fed was raising rates. Of course, the Fed has raised rates several times since aggressively, and it looks like it continues to do so. We should see some pretty strong and rapid increases in dividends as we move forward for the next several years, folks, not just once or twice. To give you an idea, if we move to a normal interest rate environment, which we're quickly getting there, we're going to be there very soon. The dividends were 7-8%. That was the norm. That's what the companies were paying on a regular, normal basis. If we get to a higher than average interest rate situation, which is looking increasingly likely, and again, this is not me saying this is stuff coming directly from the Federal Reserve. If we go to a higher than average interest rate environment to tame inflation, dividends were double digits, okay? I don't know what's going to happen. I can't predict exactly what's going to happen, but I can give you an idea of what's going to happen. Dividend rates are going up, okay? And they're going to be going up for a number of years. Now, the other side of it, that's the other thing, the other key point to understand about the personal bank concept. First step was we set up a high cash value policy to earn dividends. Dividends are going up, folks. That's good. That's great news. So insured, guaranteed, tax-free dividends are going up in returns as we go forward for the next several years at least. And how aggressive? It's getting more and more increasingly aggressively going up. Now, on the other side, we usually access funds. When you access funds to use them to pay bills, to reduce your cost of borrowing, or use it to invest in other things to increase your rate of return. All these things you can do with your personal bank. Okay, we deal with a positive arbitrage. And what I mean by that is the cost of borrowing, accessing the funds, is less than what you're earning. Now, if you're borrowing from a bank, like I've talked about for years, you've listened to this show, I've talked about accessing funds from the banks because the rates the banks were charging were between 3 and 4%. Again, folks, all that has changed. The rates from the banks is now 4.5% to 5.5% and quickly rising. The dividends are 5.75% to 6% and also rising. But here's the good news. Here's the awesome news. We have locked in through one of the companies 4% borrowing rate for the next several years. Folks, if you're earning 6% dividends, I think that's super conservative starting next year. And it costs you 4% to access the funds. What's going on? You're keeping the difference. You're keeping the 2%. And what did you do with the money? Did you invest it in something else? Taking advantage of an opportunity you saw? Because, hey, that's the other thing about recessions. And don't let anyone kid you. We are in a recession. We're officially in a recession. We've had 2 quarters of negative GDP. That's defined as a recession. We are in one. And it looks like it might continue for a while. Here's the thing. Recessions create opportunities. The prices of assets in recessions typically go down. We're starting to see that with real estate. Again, why? Increasing interest rates increases the cost of borrowing money to purchase a house, for example. So the mortgage cost goes up. And when you double the cost of interest, which has happened already, you add a significant increase in the monthly payment, which means the average person can afford less, which therefore then causes prices to decline. We're already seeing prices peaking and in many places starting to go down. I believe, this is my opinion, and a lot of experts that we're looking at, I'm reading and stuff, that 2023 is going to be a tough year for real estate. And a lot of them are also saying 2024 too. So it's very likely opportunities to purchase real estate at discounted prices, let's just say that, certainly less than what we're looking at now, are very favorable. Let me give you a few more things on that. Oh, I can't. We're coming up on a hard break. I got to stop. Stay tuned in the next segment. I'll share with you some more very valuable information on real estate, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and I got cut off on a hard break there. Apologize. So I was sharing in the last segment about how recessions create opportunities, and the price of assets, whether it's a stock or a piece of real estate or anything else for that matter, often declines. And then once the decline stops, so to speak, it's hard to judge or where the bottom is, but you can pick up assets at a discounted price. Now, if someone, say, was more or less fully invested, whether it's the stock market or real estate or whatever, cryptocurrency, precious metals, you name it, and then the prices drop and you ride the roller coaster down and you don't have much in the way of dry powder, is the term they like to put, or ready available cash to take it. You can't really take advantage of those discounted prices, can you? Now, I know there's stuff out there called dollar cost averaging and all that, but I'll tell you what, I don't think it's rocket science to see this year the stock market's been rough. I don't think it takes rocket science to see that real estate has stopped going up for the most part and is already on the way, starting going down. Cryptocurrencies, my gosh, that was really rough, right? If anybody's involved with that. In other words, it's your money, do what you want. But what I'm saying is, if you pay a little attention to what the experts are saying, okay, and the economists are saying, or what's going on, and what the Federal Reserve is, what I've been talking about before, and we get back to that. The Federal Reserve is talking about pushing the economy into recession now, actively. Okay, does it make sense to keep buying stuff on the way down? Or does it make more sense to have some dry powder, have some funds set away in a different bucket, if you will, not subject to the risks of the various markets? Your personal bank obviously is one of those, where you have high liquidity, gosh, folks, you can have 85% liquidity day one. All right. Earn 6% dividends or so. Remember, dividends are going up, and then pull the trigger when it makes sense. When it feels like things maybe are starting to get better instead of worse all the time. You know what I'm trying to say? I mean, real wealth is often developed during recessions, okay? Because people at that point taking advantage of opportunities. That's what I'm trying to say here. That's what I'm trying to help you understand. And like I said, on top of all that, if you put the money into a personal bank policy to earn dividends, it's guaranteed, it's insured, it's tax-free, it ain't going nowhere, right? And you've got access, like I said, 85% of it or more day one. Look, you can pull the trigger, and then when you do, probably pick up 2 or 3% positive arbitrage, which means you're keeping 2 or 3% more money over and above whatever it is you're invested in. You've increased your rate of return. And the fact that we've locked in 4% borrowing rate money for the next several years, folks, that's game changing. That is massively huge. Because as one of my real estate investors talked about, I'm going to get back to this now. Big ones. Huge one. Huge real estate investor. He goes, Ference, you got the cheapest money in town now. I said, I know. So contact me at toll-free 866-268-4422 or yourpersonalbank.com for more info. The other reason why I believe that real estate is going to see a rough time going forward into 2023 and beyond potentially, as many experts are saying, one of the big causes, in addition, the Federal Reserve, the easy monetary policy, no question, the low interest rate environment allowed real estate prices to go up. No question. The other big factor was institutional investors buying single-family homes as long-term rentals. And BlackRock was one of the largest, there's many others, Fidelity and others, were buying billions and billions of dollars of real estate around the country, folks. And that's causing lots of buyers, right? Economics 101, right? Causes the prices to go up. Well, guess what? BlackRock has announced they're going to stop buying in a number of markets in September and a bunch more in October. Something like the top 50 markets in the country, they're not buying anymore. Many of the other big institutional investors are doing the same thing or already have, and the smaller investors are likely have already done so or will follow. In other words, the investor market is pulling out rapidly or already has from real estate, particularly single-family homes, where they once were. What's that going to do to prices? Now, I understand there's still a demand out there, but when you have a recession and you have high inflation, those are definitely factors that are going to have an impact. Contact me at toll-free 866-268-4422 or yourpersonalbank.com for more information. Again, it's 866-268-4422. I'm going to finish up here in the last segment about some last thoughts on the Federal Reserve, what they're doing and where they're going and why.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and we have really been discussing a lot today about the Federal Reserve. Don't fight the Fed, what they're doing, why they're doing it, where they're headed. And I just love this one statement. I can't pass it up. Biden says his spending agenda took America from an economic crisis to an economic recovery. Now, folks, if you believe that, I have some oceanfront property in Arizona to sell you. So you should contact me. I'm kidding. The Federal Reserve isn't saying the same thing. And this is what's interesting, what's going on here. So, again, as you know, Federal Reserve for the past decade plus has had extraordinarily low interest rates, easy monetary policy. In fact, when COVID happened, they, of course, even started buying billions of dollars, like $120 billion a month, I believe, of bonds, which support the stock market, and mortgage-backed securities, which supports the real estate markets. Earlier this year, that stopped, and they are now talking about selling those assets sometime starting this fall. This is fall of 2022. So not only is the Federal Reserve aggressively raising interest rates to try to attack or tame inflation, but they're also looking at selling some of the assets they have on their portfolio. What do you think that's? They're the 800-pound gorilla in the room, folks. Remember, don't fight the Fed. What do you think that's going to do to asset prices? It's going to have a negative effect. But here's the other big thing, which has really cooled the jets, if you will, on the stock market in particular recently. See, the Federal Reserve Chairman Jerome Powell has signaled that they're going to take a much more aggressive stance and now willing to put the economy into recession. In fact, it looks like they're going to. And the reasoning behind it is there's the twin goals. Understand this. The twin goals of the Fed is to keep inflation at about 2% annually and to keep unemployment at a reasonably low level. Now, the problem they've got going on here is both are out of control. In other words, inflation is at 40-year highs and unemployment is at 40-year lows. And the two normally don't go together, okay? Normally when you have a recession, a slowdown in the economy, you also have less jobs. You usually have higher unemployment. But it appears there's a bigger structural problem going on. And this article I'm referring to is from the Investor Business Daily. And this is one of the best articles I've seen in a while on this. And the title of the article is Recession Warning, Buckle Up for Fed's Hard Landing for U.S. Economy and Dow Jones. And what they're talking about is, again, it's the combination of these two things and what's really bugging the Fed right now. I mean, high inflation certainly is doing that, no question. But what really is bugging them is the low unemployment. In other words, the employment economy is running too hot too, and so they've got to slow the economy down to get unemployment up a little bit, up to more normal levels because it's historically low. Not necessarily a good thing, and the problem is people having jobs, of course, is a good thing. The problem is they're actually looking at through demographics and stuff that we're running out of workers. And the reason we're running out of people to go to work, and a lot of the reason is, one is demographics. The folks 65 and plus that are aging out of the workforce, so to speak, are not going back, right? They're retiring, okay? In fact, the bulk of the labor force, those are the folks that are what they call the 25 to 54-year-olds. That's your prime working age adults. And the highest levels of full employment at the pre-COVID peak was 80%. It was 80.5% actually. And right now, the number of working adults in that age range, 25 to 54, is 80.3%. In other words, we're at the highest employment levels for the prime working age adults ever. And there just isn't hardly anybody else left. Where are these other folks going to come from? Notice there's more jobs available than people are doing them. All right. So that is one of the situations that the Fed is dealing with, because the Fed they're either going to have to change their tune, because the Fed has always thought that a 4% unemployment rate is considered inflation neutral. Okay. And we're below that. So the labor market it's not functioning smoothly, but like it did before the pandemic, just like inflation is not. It's like the plane, the analogy, and I think even this article talks about it, is the plane's out of control, it's flying and it's out of control, and the Fed needs to bring it in for emergency landing. because ain't nothing working right. You know what I'm saying? And that's what they're dealing with. Stuff's going off the charts, not working right. And another thing is the Fed wants housing prices to go down. Back to the real estate point. Because one of the reasons that the labor market is so tight is it's hard to find people to work good jobs. Two reasons: the experienced workers are retiring through the demographics. We talked about that already, but also because of the high cost of housing, a lot of people are unwilling to move to the new job like they used to in the past. Right now, I'm not here saying these are good or bad things. What I want you to understand is this is what the Federal Reserve is looking at. They consider it a negative, and they consider a situation where people are not moving to jobs a bad thing because housing prices are too high, which is another reason the impetus the Fed has to cause real estate prices to reduce. And the number one best way to reduce the price and value of real estate is increase interest rates. Because again, anyone who's borrowing money to buy a property, and the cost of borrowing goes up, that reduces the value of the property. Okay? These are things, here's the big picture. These things that the Fed is looking at, whether it's inflation being at 40-year highs, unemployment rates, the market running too hot, and them feeling like it needs to be, we need to have a little bit higher unemployment we do now. These are things that are not going to get fixed overnight. Even the Federal Reserve is talking about this. They're even stating now, even if and when they get these things stabilized, both sides of it, they're going to keep the interest rates where they're at for a while to make sure it doesn't revert back on them quickly. And the reason behind that, just so you know, is they're looking at what happened in the 1970s. So in the 1970s, we had causes similar to what we have now, although not self-inflicted, but certainly high energy prices, OPEC and all that, caused a major recession. And the Federal Reserve would raise interest rates to slow the economy down because inflation took off, right? And then as soon as things kind of settled down a little bit, if you look at the history of what the Fed did, they would start to lower the rates back down, and then inflation would flare itself up again. This went on and off more or less for nearly a decade. It started in the early 70s and really didn't get resolved to the end of the 70s when Paul Volcker, they finally just jacked the rates, the federal funds rate, to 20%. Okay? And that's what finally killed inflation off. The other thing that you need to understand to get an idea of what to expect, the consumer price index has been floating recently, last several months, around 8.5% to 9%. Even the Federal Reserve has stated to stave off inflation, to kill inflation, interest rates, or the prime rate at least, is going to have to be higher than inflation rates. Prime is normally about 2-3%, about 3 points higher than the federal funds rate. So that means we need to see about a 6% federal funds rate to see a 9% prime. And they said it's got to be higher than that. So we've probably got to see 9-10% prime, which means we need to see about a 6-7% federal funds rate. Which, what is it? Folks, that means it's going to almost double again. I don't want to be a bearer of bad news. I don't want to be, raining on anybody's parade. But what I do want to do is help you understand what the likely potential of what's going to happen is going to be. And you have to ask yourself a few questions. If indeed the Federal Reserve causes the prime interest rate to approach 10%, what will that do to your portfolio, to your asset allocation, to your investments, to your assets? Is that in the realm of possibility? And the answer is absolutely yes. and more is likely looking to be in the realm of probability, not possibility, folks. Again, I'm just listening to what the Federal Reserve is telling us and watching their actions as they follow through with it. I know people want to be optimistic and say, hang in there, it'll get better, and all this kind of stuff. But what if it takes 2, 3, 5 years? Or like we saw in the 1970s, God forbid 10 years to get resolved. I certainly hope it doesn't take that long. But I do believe, based on what the Federal Reserve is saying and what they're doing and what we're dealing with, and looking at economic history, that this could get a lot uglier before it gets better and could easily last a lot longer than most people are willing to state or even realize. And if that's the case, what's your plan? What's your alternative? What's your diversification strategy? Are you just going to write it out and hang in there and hope it and wait for it to get better? I'm not going to say hope it gets better. I believe it'll get better at some point. My point isn't, is it going to get better? Sure. My point is, how much worse is it going to get and how long will it take? And if you could had a way that you could take advantage of some of those opportunities when stock prices or real estate prices or whatever assets are hitting prices you haven't seen in years, literally. So you're looking at this and you're thinking, my gosh, I would love to own that asset at that price. But you're not in a position to be able to take advantage of it, because if you pull out of what you have, you'll lose too much. You hear what I'm trying to say? These things happen, folks. I've been in this business for 22, this is my 23rd year. This is my third rodeo. What I'm wanting to do here is try to help some people take advantage of the opportunities when they do come about. I don't think they're here yet, but I do believe they're coming. And will you be ready? Will you be prepared? Will you have access to funds that you can readily pull the trigger, have no negative consequences, taxes, penalties, or whatever, to access those funds and pull the trigger and take advantage of the opportunity when it happens? Your personal bank allows you to do that, and it's one of the only, and I mean one of the only assets that allow that, to give you that option and create positive arbitrage on top of it that looks like, because of increasing interest rates and higher dividends going forward, will only get better. So contact me, toll-free 866-268-4422 or yourpersonalbank.com for more information. Again, that's 866-268-4422. And last thing I'll leave this with on today is, as long as it's on our money, I'm going to continue to say, in God we trust.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.